Welcome back, everyone, to Vox Markets Live. My name is Paul Hill. I'm delighted again to be able to speak to equity analyst and stock market commentator Paul Scott to discuss all things small cap. So welcome, Paul.
Hi, Paul. Hi, everyone.
Well, it's fantastic to have you back on the show after a sort of like a break for 2 weeks. Again, we've had a massive amount of trading updates on the year end from small caps over the past fortnight. I don't think whether there's anything which has particularly caught your eye, whether it's the macro or sort of trends between companies that you might want to highlight to investors at all, Paul.
Just that it's all starting to feel a bit more wobbly again, isn't it? What we're hearing from the individual companies, we've had a smattering of profit warnings this week. The economy seems firmly stuck in a rut at the moment, doesn't it?
Yeah, I think you're right. I mean, there's no doubt about it. We'll go through some of those profit warnings because it started the year off on a pretty good foot, and unfortunately has tanked a few of the smaller caps. Another sort of like key area that I think probably is worth highlighting to investors came out from Calastone this week, and it talked about the UK equities, the fund flows, the net fund flows, and other than when it rebounded in November, just a small amount after the switch from the October budget, we still got a dreadful equity outflow in January, and I'm guessing that's just a continuation of the trend of people switching out of active UK fund managers into passives, US and fixed income passives, because you still see the massive amount of passive flows. I don't know whether you've got any thoughts on this one at all, Paul.
Yeah, I mean, your fund manager interviews are fantastic, and I think Christopher Mills focused in on this and said that UK smaller cap funds, I mean, are undoubtedly still seeing a lot of outflows, and that he was saying that was masked to some extent last year by all the takeover bids. Whereas now, I think certainly that's a factor that I think I underestimated. So yeah, it's a continuing headwind, isn't it? For sure.
Yeah, and then the other thing I think is worth just mentioning to investors, particularly in the sort of small cap land, and again, I'm not sure whether you've seen it, but if you go into quite a lot of sort of like 100 million, 200 million market cap businesses, because they don't have much liquidity, if you actually sort of tap on the trades on a particular day, because say the stocks are going down, I'm now seeing an increasing number of sort of single stock sales or two share sales, basically total de minimis, but it's traders who are trying to actually drive the share price down. And last time I saw that was basically during the great financial crisis, when there was so much fear in the market that you only needed a small amount of sort of like downside, and it popped people out, and then somebody picks up the shares and profits from it later on. I don't know whether you've got any thoughts on that at all, Paul?
Not really. I saw your comment on that this morning on my Substack, and I thought, well, that's interesting. Yes, I mean, some of these things are ludicrously illiquid for sure, but I'd be surprised if shares of 2 or 10 shares sales would make the market makers move their quotes. But I don't know. I don't know what their algorithms are, so I'm not sure.
Yeah, I mean, it's continuous. I mean, if you just tap on a few of them, then you'll probably see 50 to 60 to 70. Though, I mean, we're not talking 1 and 2. We're talking a lot of them just buying single digit numbers of shares. They're trying to get lower prices. And it was quite interesting that you'd had that. There was an attack on Traxys earlier last week. I don't own the shares, which is that, the software, hardware, rail tech, because it was fears about a lot of profit warnings in the rail industry, drove the shares down to about £3.20, and they've suddenly bounced back to over £4. And it just seems, I think investors just need to be aware that if something's going down, it isn't necessarily because the market knows there's bad news coming. It might well be.
100% agree. Yeah, 100% agree. And what I have my preferred list, which is stocks that I've researched thoroughly, that I know are good, solid, decent companies. Now, of course, something could go wrong at any company, but when you see those spikes down 15, 10 to 20% on nothing, on no news, you do your Googling, don't you, to make sure there's not something horrible in the press. And if there isn't, those are buying opportunities. I think there's a lot to be said for keeping, of course, I don't actually do this, but there's a lot to said for keeping some cash, some powder dry, just to nip in and grab these irrational spikes down. That you're right. We are we are seeing, and more often than not, they bounce back, don't they? If it's, you know, from the
Yeah.
quality list of companies.
Yeah, no, you're right. Yeah. Okay, let's attack some of the unfortunate profit warnings. Let's go to Warpaint. We've had a ton of investor questions on it. We've had Letitia09 this afternoon. We've had Innis Gray, who's also asking about it, because this came out with a trading update, and it seemed as though they had a very strong first half, and then they got very little growth, if any at all, in their PBT in the second half, and only 3% organic growth at the top line. The shares sank, and then you also had a profit warning from Elf Beauty in the US today that seems to have also negatively impacted their shares. Elf Beauty, which is the poster child of all things sort of like trendy Gen Z cosmetics, their shares are off 25% today. I don't know what your thoughts are on Warpaint at all, and how you should interpret the profit warning.
Yeah, I cover this one very closely, have done for years. And I actually did a CEO interview a few years ago when the big bull run on it was just starting. So I know it reasonably well, but obviously no outsider really knows what's going on inside any company. But the way I put a comment up on Warpaint's trading update before 8 a.m. And it didn't directly say we're in line with expectations or not, which is always a mistake, because people then think, oh, what are they hiding, you know? But I compared it with an old note from Shore Capital, and long and the short was it looked like a very slight profit miss. I know it was a revenue miss, definitely, but it looked like they were in line, or almost in line, near as makes no difference, on PBT. So I've been absolutely flabbergasted that this thing has dropped so much in the last couple of days. But so asking around on I mean, I said, look, before the market opened, or there was any indication on price, I said, look, at £5.30 or whatever it is, this thing is now on 20 times forward earnings, and it does look as if the revenue growth is slowing. So PE of 20 is probably too high, but I had no idea it would drop all the way down to, I think it's £3.86 now. But actually, if you now factor in slower growth, which does seem to be the case, the forward PE of 16 probably looks about right, doesn't it?
Yeah, it's a good high quality business. It just seems as though the US consumer in the younger sort of demographic has suddenly decided to become price conscious, because for Elf Beauty to effectively tank 25%, and you've seen it through, I think Estee Lauder had a similar message, albeit not a really that trendy a brand.
Yeah,
it just seems as though that was the big growth area for a lot of cosmetics around the world, you know, for these type of businesses. And if that engine's now spluttering, it puts it into question about what the growth rate's going to be.
it does. And I think they said that the growth in January was 15%, the revenue growth after the period end, and on higher margins. So that sounds okay, because that would feed through operationally geared to maybe 20, 25, 30% profit growth, wouldn't it? If that can be maintained. But there is definitely now a question mark over the growth of Warpaint. And one of my friends pointed out to me, actually, that you know, the revenue at Warpaint is still quite small. I think it's only circa just over 100 million.
125 million.
125. That's forecast for the current calendar year, isn't it? Yeah. And very good profit margins. Now, that's peanuts to some of these American retailers. You know, the Walmart is always mentioned, that, you know, it could be susceptible to destocking, or maybe an order that comes in just for a trial number of stores, you know. So there's two sides to that. There's still potentially a lot of upside from 100 million per annum revenues selling globally, but it might be susceptible maybe to lags, or it looks like the Q4 orders maybe weren't quite up to scratch because of that revenue miss. I think, but the market's really throwing the baby out with the bathwater, hasn't it? It does look to me. I was tempted to buy some today, I must admit. I didn't push the button because I found some trashy nano cap that I decided to buy instead.
Is there any tariff risk at all with Warpaint? Because obviously, if it imports it or buys the stuff from China and then ships it to the US. Is
Good
there any
point.
risk
Yeah, I'm
there?
sure there is. Yeah, because it has it made in China, doesn't it? I mean, the question is, do people find ways around this? I mean, the Chinese are notoriously good at making things and very ingenious at circumventing
Yeah,
rules. So, I mean,
yeah,
maybe things just go via third parties, from another country. I don't know, but yeah, I
mm,
think that certainly we know that Warpaint does have everything made in China, so tariffs has got to be an issue. But why did that issue suddenly kick in when
yeah,
they put out this effectively almost inline update? So it seems a rather extreme reaction. I'm wondering, maybe a little bit of a crowded trade, maybe
yeah,
stop
yes.
losses. Don't
Yeah, you
know.
could be right. Yeah, that could be something as well on it. Yeah. Anyway, let's see where it settles. It'll be interesting to see how
Hmm.
the Q1 when they come to do their trading update in April, May time. It'll be soon to see how the first 3 months have gone.
Yeah,
Another
I
one,
still
another
like it.
one.
I mean, I dropped it from, this was before the market opened yesterday. I dropped it from green to amber green on my system on the basis that it's, it looked fully valued on 20 times, but it's now down to
Yeah,
16 times. So yeah, starting to look interesting again. I don't think the growth story's gone. I think actually this might be a bit of a wobble, possible buying opportunity, but look, we don't know, do we?
yeah. No, no, they've got a lot on their hands, haven't they, with brand architects as well, because they're buying that as well.
Oh yes, yes, good point.
Yeah. Okay, let's move on to another consumer stock that has unfortunately warned, I think, yesterday afternoon, in very much in line with your Rolls Royce that parked in your next to the Mary Shelley. We've got Vertu Motors, which unfortunately warned about profits simply largely because of the new car market, saying that it's really just it's on its knees at the moment. I don't know how you saw this one.
Yeah, I didn't get it written up yesterday because it missed the cutoff, but I mentioned it in my podcast yesterday. I was actually I think it was a significantly below trading update, wasn't it? Which
Mhm.
normally take 30% off the price before you can even trade, don't they? But it didn't. It only knocked Virtue Motors by about 7 or 8%. And I have a feeling that could be the balance sheet support kicking in, because you're
Yeah,
now paying less than well, you're only paying about 0.7 times tangible asset value, and the tangible asset value is overwhelmingly freehold property. So it's now kind of a property company trading on
yeah,
a similar discount to a REIT that's also paying a 5.2% dividend yield. Oh, and it just happens to sell some cars as well. You could see it like that. The after sales side of the business is still doing fine. I mean, that's really what the rest of the business is for, isn't it? They don't
yeah,
really make money selling cars. They make money servicing cars in the first few years of their life as franchise dealers. It's not as cheap as it looks, though. On Stockopedia here, I'm seeing a forward PE of 5.9. Actually, if you use the latest broker research from Progressive, I think it is, they're forecasting only 5.5p next year, which would
mm,
actually be a PE of nearly 10. So
yeah.
people need to be aware of that. Do make sure you're using the very latest forecasts, which have dropped a lot. They've dropped by about a third. So I'm not as keen on Virtue Motors as I was, although I still love the balance sheet. I just think there's too many problems in this sector. They mention government legislation on promoting electric vehicles, don't they, as highly disruptive. You've got
Yeah.
the Chinese about to flood Britain with cheap electric vehicles because we're, I think, the only major market that's not applying tariffs to them. And with other markets applying tariffs, you
Wow.
could end up with the UK ending up as a dumping ground for all the surplus Chinese production, which for consumers could be good. I mean, I
Yeah.
drove one of these MGHS things recently. It was lovely,
Yeah.
absolutely lovely car. I mean, boring as hell, like all modern cars, but just an appliance. It's not a vehicle, really. It's just an appliance. But they've certainly got the hang of making cars. The Chinese have, I'll tell you. Wow.
Yeah. Yeah. Okay, good. Let's go to a hat trick of profit warnings. We've got Paul the Parrot. He's asking about Iomart dropped another bombshell,
Oh, that
down
was
25%. This one this one basically does data center and cybersecurity IT services to the small medium sized enterprises in the UK. It's one of the few companies that actually owns its own data centers. It was a
oh,
value. It was a value trap when I bought it at about 140, and it's a bigger value trap at the same valuation at about 45p, and I
yeah.
still hold. It's a painful one. I don't know whether you've had a look at this one at all, Paul.
Yeah, I wasn't aware of it. I know the name, but that's it. It warned on profit. Oh, I haven't given it the correct color coding. I'll have to amend that. I wrote a brief thing on it this morning. I had a quick look at the numbers. My main concerns about Iomart is it did a big acquisition recently, and the pro forma balance sheet is hideous. It's got far too much debt. And when you write, and huge intangible, goodwill, when you write, which isn't apparent from the H1 results, because I think the deal happened slightly afterwards. So do be careful on Iomart, because the pro forma balance sheet, as of now, is pretty awful, heavily negative net tangible asset value, far too much debt. So it's on a low PE, but the forecasts keep reducing, as you just alluded to. And I wouldn't rely on the good dividend yield, because when a company's got 100 million odd in net debt, you can't hang your hat on that divvy. Could be cut. So I don't like it. No.
No, I wish I hadn't have liked it when I bought it about 140.
Bad luck.
I know, yeah. Well, it's one of those things. It's an occupational hazard for what I do. But
it blames customer churn, and it said the new business it's replacing the old business with is lower margin. So, do you think they're being undermined by Amazon and the big sort of hyperscalers, maybe?
What they've got basically, I mean, the bull case theory is it's got data centers. And it sort of like centers a lot of its activities on cybersecurity, on Microsoft cloud, etc. So it's got good growth opportunities, no doubt about it, and it should be a beneficiary of the AI. However, at this point, you need to ask: is it actually? Do you really understand it? Is it a good business or a bad business because it keeps going down and not growing with the secular growth trends behind it, or is it actually run by poor management, or is it both? And you need to come to a conclusion on that. And I haven't done. And what's actually happening is it's got a legacy business that I think is less than that now, 20% of revenue that you're basically losing revenue. And that's largely to do with straight hosting and just very simple type of, there's no real service wrap on it at all. And therefore they're losing that business to cheaper rivals like Amazon and to, probably even Microsoft and Google. Yeah. And it's only the one where they've got effectively proper sort of like, public cloud services in the cybersecurity and AI and all this sort of stuff where they're growing. And at the moment, that growth hasn't yet been able to offset that churn. So to me, I think you're totally spot on, Paul. Look at the balance sheet. I would not, I mean, you sort of like have to decide whether you're going to, for me, something like you're going to double down. There's just no chance I would double down given on the balance sheet, because it overpaid for the ATEC acquisition. It did, left itself quite precarious on about 2.5 times EBITDA, net debt to an EBITDA. It only needs a small problem to happen, then it breaks those covenants, and then it's got a real issue. So no, I mean, it's got lots going for it. It's still got the bull case, still hasn't been blown out, but it's hugely high risk now because it doesn't need much to, but the share price is on its knees, albeit I would say it's the same valuation, the same PE rating as when I bought it at sort of like 70% higher.
Yeah, and something else that you just triggered with me is that the company quotes Iomart, it quotes EBITDA, but I noticed I always go to the broker note and see how that translates into profit before tax, because capex, depreciation charges, finance charges, they matter. You can't just ignore them. And anyway, EBITDA is almost 4 times PBT, and that's adjusted PBT as well. So the EBITDA numbers are absolute nonsense.
Yeah. Okay, well, another hard lesson for me.
Bad luck.
I remember you mentioned last time you spoke, your biggest losses are the jam tomorrow type stories. My biggest losses by a mile are values traps, basically, because I get hooked in by this. It's got secular growth. It's a cheap valuation. It's going to be a winner. And I'm wrong because it's very difficult to know whether it's actually got real USPs to help it grow with the market. Because if it hasn't, then you are absolutely stuffed. And as I say,
that was a great point you made last week, and I was only thinking about that this morning. Actually, I think I'm the same. And the trouble is, if you buy into these value shares, because we're obstinate value investors, we double down. We double down again, and we just refuse to admit we're wrong until it's far too late. And so I take the view now, don't buy the damn things in the first place. That's the lesson I've learned, I think, over there. I'll still get it wrong, obviously. Yeah. But that is a really key point to keep front of mind, definitely, Paul. Yeah.
Yeah, and so you miss up you miss, well, basically I get sucked into value traps, but equally being obstinate. I try to look for sort of like, it's difficult for me to look with fresh eyes because it's sort of a good intro to this next stock, which is Filtronic, that
Oh
I
yes.
was hurt. I've sort of kept away for the last 20 years wrongly, and suddenly has increased. We've got a number of people asking about your latest views on Filtronic after their result. They've got TK51 and many others. I don't know what your most recent thoughts are on it.
Well, I mean, the numbers were fantastic, weren't they? The H1
Yeah,
numbers, but we know why, because they've got this new product that seems to be an absolute global blockbuster, particularly, but with large
yeah,
lumpy orders, particularly with SpaceX and so on. And obviously, the Elon Musk stardust is sprinkled over it, with them having warrants in it as well. So it's a very, very exciting story. I decided to ask my co-writer, Dave, to have a look at it just to get some fresh eyes. I don't hold the stock personally, but I've certainly been very positive about it. And Dave wrote a nice balanced thing on my Substack, giving the pros and the cons. The fundamental thing is it's essentially guesswork on what the future orders are going to be. And we just don't know. I don't know. There's no, and I don't want to base my investment on essentially guessing at what I think is likely to happen when I know nothing about the products or the competitive situation. So that's the only drawback we see with it. This is almost a one-trick pony, really, in terms of a product. And we've seen in the past with Filtronic, it's had blockbuster products which have a lifespan of a couple of years and then the competition catches up. But this does feel different this time, I have to say. This is a much bigger deal, I think, what's going on. The numbers are so impressive that we couldn't help but be positive on it overall. But we don't know what's going to happen in the future. That's the main drawback. Your view, Paul?
Well, I actually spoke to Richard Staveley, the Rockstar fund
Oh,
manager
yes.
at Rockwood about 2 weeks ago, and this is one of his stocks, and he believed, well, he's going for the 10 bagger on it. He bought a big chunk at about 12p. It's now at 94, and he's going to hold it at least until he believes that the current forecasts for Filtronic for not this year but the year afterwards are just ridiculously low. He actually thinks they're going to win new contracts, because what's happening is that you've got a bit of this 12 months, you've got a bit of a spike in demand from the SpaceX, where they basically, kit out a lot of their base stations with these wireless communications devices, which then means that you've got difficult or tough comparatives for 2026. He actually believes they're going to win new contracts, and/or they're going to be able to put the wireless communication devices into the satellites, the low Earth orbit satellites for SpaceX. So he thinks those estimates which are out there, the brokers, for 2026 are totally wrong, and the company's going to blow through it. So,
I hope he's right, but it's not the sort of thing that you and I can make a judgment on unless we've got inside information, in which case we couldn't trade the shares anyway. So, that's the problem with this type of thing. I want to base my investment on guesswork, or that so and so said this or that? It's very difficult, isn't it?
Yeah, well, it's always a bit of guesswork, isn't it? Because there's been an outside investor, you never get proper sort of like, you can't get all the detail. You just don't know all the moving parts. You just have to.
And I think the broker did justify their low forecast by saying that the company had said some orders had been pulled forward by SpaceX. So I think that was the specific reason for that, wasn't it? But as I say, it's just not something I can really even make a vague. I can't judge it. So for me, it's just I'll sit on the sidelines. But well done to everyone who called this right. It's lovely to see people making 5-6 times or more times their money.
No, it is. Yeah. Okay, another one which has done very well. Got a question from Abel Suvini. He's basically asking about Alumasc, which is a building products business that has really sort of like performed perfectly. It does it for sort of like water management on buildings and offices. Does all kinds of different ventilation and stuff. And I think it's sort of won a big contract out in Asia with an airport, if I remember rightly. But I don't know how you see this one.
Very positively. My readers actually flagged this to me. last year. It was one that I don't know, I just never really looked at. Maybe it's because the name sounds a bit like a resources company. But anyway, I looked at it when it was just over £2. And I thought this thing's crazily cheap and trading really, really well. So yeah, I did a nice bullish piece on it, and some of the readers have done well on it. It's really shot up, hasn't it, in the last week or two? I think it was an inline update. I think I'm right in saying. But it's bucking all the trends, because for building supplies, product companies, you'd think most of them are saying they're really struggling. But Alumasc, it's almost as if none of this downturn has happened. They seem to be. I did have a nice chat actually on Zoom with management a while ago, 6 or 7 months ago, and I just thought, they seem a good, steady management team, but they're performing brilliantly, aren't they? I mean, I don't know what the secret sauce is, because this thing makes great operating margins. So it's obviously got pricing power. It's got some sort of unique products that are in demand. It's as simple as that, isn't it, really? And everything seems to be going well, all the different divisions. And you're only on 10.7 times forward PE. You get 3.5% dividend yield. The balance sheet's not brilliant. It's okay. It's got a bit of debt, but not problem levels of debt. So no, I remain very positive on this. And look at the forecasts as well. They're just being continuously upgraded. So a rare beacon of light in the building products sector, I would say.
I think, I've got a sneaky suspicion that their secret sauce is that they do niche products that are going into commercial properties, whether that's offices or airports or other infrastructure, that needs to get to new environmental standards in terms of air ventilation and water management. But equally, you've got lots of tier 2 and tier 3 offices that now need to be upgraded to get to tier 1.
Oh, that's a good point.
And therefore they service the commercial property that is really the, which is growing, because that's where a lot of corporates want to go and house. If they want to come back into the office, they don't want tier 2, tier 3 properties. They actually go for the real the creme de la creme. And I think that's what they're servicing, those, which means that essentially there aren't that many suppliers in this particular area, and there's a shortage of supply, so helping the pricing.
Very interesting. Yeah, that all makes sense. And as you say, environmental drivers on things like the green water management products. And there was something about the Hong Kong airport contract.
That's it, Hong Kong airport.
It was delayed, wasn't it? And then it came back. Did it come back, or I can't remember the details of it? But
I think it's driving revenue at the moment. I think it's a really good.
Is it? Yeah, because I remember they hit their numbers, even though that major project was delayed a while ago. So it seems to be doing great, doesn't it? So I really like Alumasc. Growth at reasonable price.
Yeah, I think remember Lawrence Halls at Dowgate or Onward Opportunities said that they got these huge sort of like sink funnels that help flood water from the airport to get off the actual, these are absolutely enormous things that effectively handle huge amounts of flood water within, effectively nowadays you get cyclones and you want to get rid of that water very, very quickly. And I think that's what it does.
Yeah, and they've got some roofing product for flat roofs, haven't they, that lasts 100 years or something like that, I think. But very interesting, as you say, niche products.
Okay, we've got two people asking about. We've got Gordon and Phil Curtis asking about JD Sports, your latest, because it keeps going down. They're wondering, is there a tariff issue here as well, in terms of, obviously they've got a big business in the States. I don't know, but it just seems to be not as badly as Iomart, but it's going a bit ski slopey.
It is a bit ski slopey. Yeah, I do hold this personally. So far I've been wrong on it, unfortunately. But forward PE now is only 6.6 times, which for a quality business, it makes almost the same profit as Next. But it's less than, I think, half the market cap. Self-funding growth. I really like the business. Although the one thing I would point out is that they're slipping out forecast downgrades under the radar. So looking at the consensus broker forecasts, it's really dropped sharply over the last 2 or 3 months. So It's put out, I think, a couple of minor profit warnings late last year, but I don't think it's clearly not trading very well, is it? But at some point, how low does the price have to go before people recognize the value? So I'm of a mind to probably buy more, but so far it hasn't worked, has it?
Well, yeah, it's trading. Was it 6.5 times PE now? Is it or something?
Yeah. And there's no structural debt. The EV, that includes the lease liabilities, which of course are not debt. They're just future operating costs. So I can't understand the valuation.
Yeah, got a follow-up question from Lemon Physical asking about Warpaint, saying, "Do you read anything into Shore Capital not publishing its notes?" I've got a view, but what's yours?
I hadn't even thought about that, to be honest. So no, what do you think, Paul?
Well, I actually think they're in a blackout period because they're doing a public deal for brand architects. I don't think, given it's the house broker, they're allowed to publish a new note because it would jeopardize that potential public bid. But yeah, I think it would, because they'd basically have to roll it. They'd roll it. Usually when you get basically a broker and you've got a public deal, then they go silent as a blackout period.
Oh, okay. Fair enough.
And I'm guessing that's probably the case. Okay, let's move to another one in the building industry. We've got a Victorian Plumbing, which we hardly ever talk about. And the reason why I mention it is because I did an interview with Stephen English of Stellar Asset Management on Tuesday, and got to the end and said, "What's your favourite stock for 2025?" And he pulled this out of the bag. And basically what he's saying...
I heard that. I was quite surprised,
I nearly fell off my chair. And I was thinking, why? And then I don't know if you had a look at it, but basically what he was saying was that the number one bathroom supplier, mainly online, and they've traditionally been into consumers, but they're expanding into trade. They've been bucking the market. And what their sort of secret sauce is that they're now doing far more of their own branded plumbing and accessory products, which carry a higher margin than third parties. They make 55% gross margin on their own, which is 80% of the turnover, compared to 35% on third party, sort of like taps and sinks and this sort of stuff. And he says they pulled off an unbelievable deal by buying one of their competitors, Victoria Plum, and then closing it. I don't know what you think about this, but it was a really it took me by surprise that he chose it anyway.
Yeah, they bought their competitor with a very similar name in order to shut it down.
Yeah.
Which is pretty brutal, but there's one way of dealing with things. I think it's a good business. I've covered it since it floated. It obviously, like a lot of things, floated on a ridiculous valuation, but then it reset to something a lot more sensible, cheap even, and it's recovered quite nicely since the lows in late summer 2022. I think it's a good business. I've just had a fresh look at it this morning, and it looks priced about right to me. At £1.05, that's 17 times forward earnings, which already allow for a fairly substantial uplift. The forecast is for profit to quadruple this year compared with 24 and double compared with 2023. So I would say, it looks to me as if upside's already priced in, and I would say priced about nice business, priced about right. I think your view, Paul?
Yeah, I think. It's difficult for me. I'm just not very good at sort of like bathrooms and retailers and this sort of stuff. So I can't really distinguish between what's good. It seems to be on all KPIs outperforming its competition, a bit like Alumasc. But isn't the kind of stock I would typically go for. But say it was his number one, which was worth mentioning.
I think at one point in the low, where it was near the lows, I did flag it to my readers and said, I think at that point, off the top of my head, I'm pretty sure the net cash was about half the market cap, and it was a profitable cash generative business as well. So it was a screaming bargain at the lows. But I think it's now reset to probably a valuation that's about right. So for me, that's not really of any interest. I don't want to buy something that's already got punchy forecasts, sit and wait 3 to 5 years for it to hopefully outperform against the forecasts. That just doesn't interest me.
Yeah, yeah. Okay, good. One company that came out with some blockbuster contract news today was Optima Health, which was a spin out
Yes.
from Marlowe. And I chatted to Christopher Mills of Harwood Capital about 3 weeks ago, and he highlighted it to me, and actually thought they've got some big sort of like ticket potential deals in the pipeline. And this is obviously one for the armed forces in the UK, £210 million 7-year deal. I don't know whether you've had a look at this morning at all.
Yes, well, you and one of my readers both flagged this morning, and thank you for adding the comments, by the way, to my Substack. It really adds value, Paul, and that piqued my interest. So I thought, I haven't heard of this before, so I'm going to have a look at it. So I spent most of the morning actually digging into this one. Just my sort of first view of it. It floated in September, didn't it? As you say, demerged from Marlowe. It's already put out maiden H1 results, so we can see what the clean balance sheet looks like, and it's fine. There's no assets there to speak of, 3 million net tangible asset value, the way I calculate it, but it doesn't have any physical fixed assets or any inventories, because it's basically it's a people business. Took me a while to actually figure out what the hell they do, because they use the most ridiculous description. Why can't they do, there's paragraph after paragraph of how we offer solutions that are tailored to the customer requirements and all this type of thing. You're thinking, yeah, but what? What are you actually doing? Anyway, I've nailed it to 3 words. So my description of it is outsourced health services. Yeah. And that's it. So it's a people business that supplies occupational therapists, doesn't it, to public and private sector, makes 7 to 9% operating margins. There's a good broker note out today, available on Research Tree. It's priced about right. I think it's had a nice run recently, as you can see. Oh, you got the chart up there. I think at that current level, probably priced about right. And Christopher Mills made a great point in your excellent interview with him, where he said because it demerged from Marlowe, the shareholder base may contain institutions or high net worths who are not really that interested in holding a scrap of Optima Health. And so you could have an overhang of those people just wanting to sell. So, which is plausible, isn't it? So I take the view, I'm not going to chase this move up. I think the armed forces deal, by my calculations, adds about 20% to the current run rate of operating profit. But it doesn't start till spring 2027. So, and then the forecasts for 2025 and 2026 are quite punchy. It's already factoring in a fair bit of growth. My only slight worry is that as part of the demerger process, maybe, the forecasts were juiced up a bit. Maybe management feel under pressure to put exciting forecasts out to attract attention to the company. I don't know. So I'd rather give it, maybe 6 months or a year and see how it performs. But I think actually for a new listing, it's one of the best ones I've seen in ages. So, mind you, that's not saying much.
I would add, actually, that contract they won, the 220 million, okay? Yeah. Optically wise, they want to basically say that they're going to lower margin than...
Yes.
Okay. But let's be clear about it. It's only going to kick in 2 years' time. You imagine the productivity through IT and software that they can kick in to improve those margins over that period, and I suspect by the end of that is going to have very good margins, because you've got all the learning efficiencies, all the productivity improvements from technology. When you're seeing people, etc., for doing their health checks, I suspect that's sort of like behind the scenes that will deliver some really good profit for the business.
Yeah, you could well be right, because the last thing you do when you've just won a 210 million contract with a major customer is brag about how profitable it's going to be, don't you? So no, I picked up on that point actually independently when I wrote about it today, in that I thought, well, hang on, they've got these various facilities with occupational therapists in them. It's going to be, this story is all about utilization, isn't it? It's going to be about winning more, bolting on more clients, but getting more out of their existing premises and staff. So yeah, I can see why people like this. I think it's a good don't get me wrong, I'm positive about it. I think it looks interesting. Yeah.
Okay, we've got a question from Nicholas Slater. He's asking about Assetco, which I own. I don't know whether you know anything about it. It's a fund manager.
I'll let you talk about this one, Paul, because I don't know it.
I'll just be quick then. I've owned this for about 2 years. It hasn't been as bad as Iomart, but it hasn't done particularly well for me. It was another value trap, unfortunately. Anyway, the people who run it, it's headed up the exec chairman is Martin Gilbert from Aberdeen Asset Management. And I think Christopher Mills is on the board actually as well. They've got one part of the business is the old River and Mercantile fund manager, which is now called River Global. And they've also got a 30% stake in a fund management platform called Parmenion. They're now going to split into two. So this is a special situation. Plus, they've got about 20 million or 15 million of cash as well, which will stay with River Global. And I think you'll see a major sort of valuation catalyst once that splitter happens. And I did notice Christopher Mills has been buying ahead of that. So he believes, because the Parmenion, I think the market cap for Assetco is probably around about 40 million or something like that. And the Parmenion stake is worth about 70, 80 million pounds on its own.
Wow.
And will be traded as a listed entity itself. And I could see somebody buying that, i.e. somebody who wants to buy the whole Parmenion, just picking up that particular stake. So I actually think will be a good unbundling, and that's what Christopher believes, because that's why he's been buying. So would I add? No, I wouldn't, even though there's significant upside. However, I wouldn't be selling, because River Global is worth something. How much? It's unprofitable, but they could sell it to somebody like Premier Miton, for instance. You then get, let's just say you got 20 million for that. You would then get 10, 15 million for your cash. That's 30 million. You could get 70 million. You could get 100 million out of this. And I can't remember what the market cap is. Let me just have a quick look.
48 million.
Well, there you go. You could easily double your money on it,
So this Parmesan thing, what's that all about?
It's basically a bit like there's another one. There's a Fintel. Do you know Fintel on AIM? It's basically like that. It's a platform that serves IFAs to be able to.
Simply Biz. It used to be called Simply Biz, didn't it?
It's like that, and it's a similar size, or maybe slightly bigger than, and they own 30% of it through some mechanism. But anyway, I don't want to get it. I've had too much bad news on that one. I just sort of like.
It does sound interesting. And as you say, Christopher Mills' outfit, Harwood, they're on 18% and recent buying. So
yeah,
you've also got Richard Griffiths, I see in there at 3%. He's been buying as well.
Okay, let's move to a REIT, or it's a company that isn't a REIT but will be a REIT, because I know you've been buying some REITs. We've got Grainger, which is the UK's biggest private residential landlord. It's got about 11,000 properties in the UK. It's talking about really good, strong rental growth, and it's also got low vacancy rates. It's about 96% occupancy, etc. And they're hoping to they will be converting to REIT later this year. And they reckon their EPS is going to go up by 50% because they've got effectively a strong, rental growth. The killer, or should we say the real sort of key is what's its valuation for net tangible assets. I think net tangible assets is about £3, currently trading at about 215. I don't know how you see this one at all as a potential REIT, just as a value opportunity.
Yeah, I had a quick look at it because it's not one I've followed in the past, but these things are so simple to understand, aren't they?
Yeah.
They just own a load of property and they rent them out. So it doesn't look particularly attractive on the basic numbers. 4% yield. I've got a discount. I've got a price to book of 0.86. But I'm not sure what figure that's picking up. But I think what is interesting is actually the most recent update where they talk about selling off low yielding non-core assets, and they're recycling the money into much better new build sites, which are generating much better returns. And presumably they're going to take on a fair bit of debt, I would imagine, to do that. Do you know off the top of your head how much debt it's got, Paul, the loan to value?
I think loan to value is about 50%, because I think it's got 1.5 million of debt, I think.
That's quite high for a REIT style company, isn't it? Most of them are around 40% or less these days, I think.
Yeah, I think because they've taken on quite a lot of debt because they've got that build to rent. They're actually building a lot of new properties rather than actually. But a lot of that debt will be funded by sales of their old sort of legacy portfolio of old social housing that is basically once the person dies, then it goes back, it reverts the ownership, then they can sell it, so they've got that sort of like to be able to monetize going forward.
Yeah, I think it looks potentially interesting, but I have to say though, I think on a standalone basis, Grainger looks quite interesting, but I think when you compare it with how cheap so many existing REITs are, or cheaper, and giving you yields of 8, 9, 10% are commonplace, I'm not sure this tempts me enough to want to buy this instead.
Yeah, I could see somebody buying them, to be perfectly honest. But then again, Blackstone would pick these up because they're going into. There's lots of the US guys who have just bought up huge portfolios of private rental, sort of like units, and this is the biggest. And Lloyd's has been talked about as a potential acquirer as well. But
I'm sure you're right. I mean, there's a sort of structural thing going on at the moment, isn't there, of transfer of ownership of REITs. All these funds who paid over the odds for their shareholdings in REITs when in the zero interest rate environment are now just selling out. And we've got that indigestion going on, which means you and I can pick a lot of these things up at valuations that are far too cheap. I mean, I like Warehouse REIT, WHR, because Blackstone are buying up warehouses and they're paying far more for them than the valuation of Warehouse REIT. And meanwhile, I get 7% odd yield while I wait for somebody to buy it. So I think I love the REITs area. I think it's a fantastic area where if you're patient, we should do really well on lots of them, I think.
Yeah, no, I'm with you, particularly as sort of property prices are increasing. Right, we got a new question from Eddie Boots. It's quite a difficult one, this one, Paul. It's about the recruitment sector and particularly Gattaca, which does the STEM expertise, the science, technology, engineering, and maths type of areas that it does the recruitments for. But obviously, like everyone, all the other staffers, the share prices haven't done so well. Any thoughts on Gattaca at all?
Yeah, I did buy some of these a few months ago, actually, at around 85p, I think. And I got bored within a few weeks. I think something else cropped up and I thought, well, that's cheaper. You know what it's like. We all do it. So no, I mean, look, the key numbers on Gattaca, I wouldn't be valuing these things on PEs at the moment, staffing companies, because they're all in such a dire downturn. I mean, I just don't understand it. I don't understand. And it's international. The bigger ones like Hayes and Page Group are putting out awful numbers, and they're largely international, Europe and Asia and UK. UK is quite a small part of them. So Gattaca, I think I'm right in saying, is more UK focused, but I could be wrong. It's tiny now, 22 million market cap. You're getting a 6% dividend yield, and the unusual thing about Gattaca is how strong the balance sheet is. It's massively strong, and it's actually trading at 0.85 times tangible book. Well, you don't see that very often, do you, for staffing companies? And actually, it's coming back to me now, its last trading update was actually better than I would have imagined. I think it showed improved profit. I mean, it doesn't make much profit, only just over £1 million, but it actually, everyone always says, oh, it's badly run, it's a rubbish business, da, da, da. It seems to be kind of starting to, it's more than stabilized. It's better than stabilized. So I think it's worth a fresh look, actually. I might might decide to go back in on that one if I get any spare money.
Yeah.
Have you looked at it, Paul, this one, Gattaca?
I have. I know a lot about it. All I would say is that, to me, it's at this stage in the cycle, all the recruiters are really, really struggling. And whereas I thought I understood at least relatively simple business model, I don't think I do. Simply there's something happening behind the scenes with the staffers, that whole industry. Yes. I don't know whether it's LinkedIn or social media or whatever it is, but it just. I would expecting them with a strong unemployment situation. I would expected it to sort of start ticking up rather than continue to go down. So I can't. Yeah. I just don't understand the industry as I thought it might. I thought it did.
You wrote a big sector note, didn't you, a couple of years ago, covering all the recruitments? I remember the graphs in it. Yeah. No, I'm the same. I don't understand what's going on with the staffing sector. We've got a guy who runs a business in that sector, a private business, I think, who contributes towards the comments in my Substack, and he says, "No, you're talking rubbish, Paul." Oh, no, he didn't say that, but effectively, he said, it's regular as clockwork. It's just highly cyclical, and it will recover as it always has done in the past. He said there's not technology affecting things, it's just hyper cyclical. So I don't know, that's what I've been told. And also I think I've heard from people in the city that it's all about work from home. People are, getting these edicts from their existing employers saying you have to come in 5 days a week, and they don't want to because it's expensive by the time you paid the season ticket and pay for lunch and all the rest of it. So they're actually going to recruiters and saying, I want somewhere where I can do at least 2 days a week at home. And they're moving jobs based on offers where the new employer says, yes, you can have 2 days at home or whatever. So you would have thought that would be good for the staffing companies, wouldn't you? There's no sign of any green shoots from any of them. All the trading updates we've had in this sector so far this year, I can't recall any of them saying things are improving. It's absolutely, it's minus 17% like for like revenue, I think, on the big ones. I just don't understand why it's so severe, this staffing downturn. So who knows?
Yeah.
Should we be buying the bombed out valuations then, Paul?
It would be the kind of things I would buy as value plays, but I don't know whether it's a value trap, to be perfectly honest, the whole sector. So
I think as long as you've got decent balance sheets, and S3 is the one I like, ticker STEM. That's got 70 odd million net cash. Gattaca's got a bulletproof balance sheet. So I'd probably, if I was going to start dipping my toe in, I'd go for the ones with the bulletproof balance sheets.
Yeah, you might find that basically S3 buys Gattaca, but hey, who knows? Who knows? Okay, let's move to another one. We've got peer-to-peer lender Funding Circle came out with really, or should we say, no, it didn't come out with anything. I don't think it was basically a Times article that triggered a 20% or 15% decrease in its share price, claiming that the documentation that it gives some of its borrowers wasn't correct, and some borrowers who have personal guarantees have taken it to the court because Funding Circle has sold these debts to a third-party hedge fund to actually collect. And the court has come to the conclusion that it's going to be referred up to the higher court to see whether the borrowers under their personal guarantees can just walk away because the documentation doesn't meet it. Any thoughts on that? And also just generally, would you buy on the sound of cannons? Because this is the sound of cannons for a real sort of like darling, actually.
Yeah, it's a pity, isn't it? Because I was really quite keen on Funding Circle, and I did catch, I think we spoke about it last year, I did catch some of that nice bull run, but not much of it, just the tail end. But I sold them when the market generally was just going wobbly. It's doing a lot of buybacks, I see. It has put a statement out. I didn't realize that it had put a statement out. Because it dropped about 30 odd %, didn't it? By about a third. I think it bottomed out around, what had been trading around 120, 130. It bottomed out at around 90p, didn't it? And it's come back up a fair bit now, so £1.10. So it just shows with these things, isn't it? People who put stop losses in, you can just get booted out at the worst possible time. But have you noticed how many legal problems there are affecting so many companies and sectors at the moment? There's risk everywhere, isn't there? Often risk that you hadn't even thought about.
You've got the supermarkets with their equal pay, and you've got obviously the car motor finance thing.
Yeah, the courts seem to be almost. I mean, I've been told off by readers for saying this, but the courts seem to be almost like a shadow government, don't they?
Yeah, I know.
Making often retrospective type judgments that could be really serious for companies. I mean, what's this? It's saying no question has been raised as to the general enforceability of the loans. This is a very brief update from Funding Circle. The case is going to full trial, and we're confident Azero will be successful. Well, I mean, all I would say is I don't know. I can't judge it. Yeah. So that for me makes Funding Circle uninvestable, because I'm just guessing on what may or may not happen, and I try not to do that.
Yeah, I mean, it's one of those things to a certain extent. it might be just a test case. Somebody's basically brought this to the, to the judges, but because it's not absolutely nailed down, the judge for some reason has decided to refer it to a higher court. Okay, so it isn't total black and white, is it? Clearly isn't. There must be some ambiguity because they wouldn't have referred it. The bigger issue is if they lose it, Funding Circle, it obviously doesn't help their lending book. But actually, I bet you they've just lifted and shifted their identical documentation for lots and lots and lots of other firms, and with personal guarantees, like all the banks, for instance, who just give business loans, like NatWest and I mean, who knows? But this could be a bigger issue if the guarantor does win in the final court. But I don't know. We'll wait and see.
But would you take a risk and buy?
No, I wouldn't. No, I wouldn't.
Me neither. Me neither. You can't. You can't. There's a big legal case going on. You can't sleep at night, can you? No. Owning the shares,
If I was really considering to buy it, I would actually try and speak to somebody in Funding Circle to try and get a copy of a draft, their typical agreements they give out to the guarantor, to basically borrowers, and have a look at it myself, and then ask a lawyer to see what's the issue, just to understand it in more detail, to be able to try and gauge it. But it's clearly a bit ambiguous because the judge wouldn't have referred it otherwise.
Yeah.
Anyway, let's move sectors. We've got one. The share price has been tanked. Which we don't talk about very much, is TENG Lifestyle. This is basically.
Why did this come up? Because there hasn't been any news from that, has there? I looked it up before, so I wasn't sure why you'd put this on the list, Paul.
I put this on the list because I basically looked at the share price and then reached out to the CEO. Alex Cheetle, just to have a chat, because I've never really come across it. Anyway, it's a it's an outsourced sort of white glove, high touch concierge service, okay, for ultra high net worth individuals. And so basically, it's most of its revenue, 80% of its revenues are contracts with the likes of, I'll just turn it over, the likes of sort of like HSBC and all the big banks, and who want to basically look after their particular clients. But the key is that most of this, 80% of the revenue, is sort of like repeat. They've just won some big contracts. They're expecting revenues to rise sort of 8% like for like. And they're basically, their USPs, their scale. They're infinitely bigger than anybody. This is a niche area. They're infinitely bigger than anybody else. All their clients, as you just see to, they've got this tech platform that makes it sort of personalized for the individuals, and which they've been investing heavily, which is one of the reasons why people have said, so I look at the sort of the cash generation of it, and sort of like, what's actually happening there. But they've got a rock solid, they've got a pretty good solid balance sheet, 9 million of cash, which is about 9p per share. They've just done they did a placing in September at 63p. Now, the key question is, how economically sensitive is this? And I asked the CEO, if they start, and what he said basically, actually, the ultra high net worth individual for these banks, basically, they make so much money. The banks make so much money off these individuals that they want something really exclusive. And as I say, they have dedicated exclusive experiences, the top restaurants and top shows and all this sort of stuff. And I just think if you look at the share price, it's on its knees, and I think it trades at about 11 times with a sort of like a good solid balance sheet. I just thought, I don't know if you've ever had a look at it at all. Sort of,
I've followed it. I've followed it for years, but the last time I looked was, as you mentioned, September last year, when it did a 5.5 million placing. I haven't looked at the preliminary results, which came out in November. That was for August 24. But looking at the summarized numbers, it does seem to have turned a corner, because it was a sort of serial loss maker, wasn't it? But I think it's now moved into profit. I mean, from the blurb, not the blurb, from the summary you just mentioned, I suppose large lumpy contracts could be a potential risk there. I've never really seen the point of this business, because it didn't really make any money. But now that it looks as if it could be turning into something a bit more interesting, couldn't it? I think it's maybe something we'll have a fresh look at and see what we think. What
could really catalyze it is they've done this IT system, which is just like there's nobody else got it, really hyper personalized to those ultra high net worth individuals. And the reason for that is that not only is the really wealthy people like using digital, but it's more so it allows them to have still a high touch service to the mass affluent. So basically, they can service lots more new customers without increasing their head count, because to service these people they can do a lot of it on the digital side. So it's certainly an interesting one.
Yeah, one thing, just look at the cash flow statement. I see it capitalizes 7 million a year of development spend into it. So that means we can safely ignore the EBITDA numbers. So I think I did have some concerns over the cash flow. Just looking at the net assets, basically zero, £2 million net assets. So there's no asset backing there. I think the cash, it looks like it's offset by borrowings and maybe some upfront payments from customers, I think. So there's not really any balance sheet support. Cash flow a bit suspect. So I'd want to get into the finer details of it, but it sounds like it's got potential. So we always have to look at things with fresh an open mind, don't we?
Yeah, and the key question is can this be a platform and to scalable? And it's perfect. I think you could find this one actually now that they've built their software that it goes. But you're right. Let's wait and see.
Well, I think actually looking at the chart, Paul, and combining that with the fact that the news flow has been reasonable, now is probably the time. If we're going to buy it, we should probably be buying it now, because it's only 42p, isn't it? It was a quid a few months ago. Oh no, a year ago. Yeah.
Okay, good. We've got a question from Grant asking about Cohort, the defense business. It's got mainly does sort of recruitment, but also a lot of cyber security and electronic warfare activities. Obviously, you can't see deep into that business because it's all strictly confidential with the defense, with the MOD and the DOD out in the States and stuff. How do you see this one? The shares keep still performing very well, actually.
They do. I mean, I've been very positive on Cohort over the last few years, and I interviewed the CEO of this as well a little while ago, a year or two ago, and I think I remember him saying it's basically 6 standalone companies that are not particularly integrated. They just buy very carefully and very rarely, and they don't seem to have put a foot wrong in terms of the defense businesses they've bought over the years. So I think it's a nice, decent, well-run, carefully managed business. The only thing is the valuation now, I mean, it's basically doubled, hasn't it, in the last year? And you do reach a point with these things where you have to say, well, it's gone high enough. It's on forward P of 21 times. Dividend yield's only 1.4%. Balance sheet's okay, nothing special. So I'd say it just, but mind you, the forecasts have gone up quite a lot, haven't they? And I think, this is the one where there's been loads of good contract wins as well, haven't there? But I mean, I've got to say, it's 20 times even on the higher future years forecast earnings. So it just looks up with events now, the price to me, but very, very nice company, no doubt about that.
I wonder whether somebody's going to buy this. It just keeps moving up, but
could be. Could be.
There's slow defense, isn't it? It's sort of like there's lots of quite of M&A in that area. Okay, we've got
Kinetic is the bargain in the sector, isn't it? Kinetic QQ.
Yeah, the services one. You're right. Yeah, that is.
Very, very good value.
Yeah. Okay. Got a final question from Innes Grays asking about H&T, which is basically the UK's biggest pawnbrokers, and they came out with quite a decent trading update, but it hasn't done much to the shares. They still traded a huge discount to net tangible assets. How do you see this one? Is it a value trap or is it a value play?
I should just have an old tape recorder next to me and just press play, shouldn't I, for my standard spiel on H&T. It's cheap. PE of 6, forward dividend yield of 6, 100% asset backed. I think I can't remember what the latest statement was, but I have a feeling it was quite reassuring off the top of my head. Can you remember any details about it, Paul? Oh, here we are, 9th of January.
Yeah, I mean, basically, I think their pledge book went up by sort of 10-20%. It's about 125 million. I think their jewelry business is doing okay. I mean, it still is just dead cheap. I just haven't got a clue why the market is so cautious on it, other than,
Yeah,
basically, is there some regulatory issue out there that we all don't know about, or are they competing against organized criminals who basically use pawnbroking as a money laundering activity? But
I
if
don't
there was,
know. I mean,
it doesn't seem to reflect in the financials.
no, no, it doesn't. I'm trying to find my spiel on it, but I can't. But yeah, I mean, the headline numbers look very, very cheap. I mean, oh, here we are. H&T. This was 9th of January. Quote, trading was robust in the seasonally important fourth quarter and was in line with management expectations. Yeah, doesn't seem to be
Looks
any
good.
problem with it. I mean, I do wonder if it might be a victim of disorganized criminals, let alone the organized ones. Sorry, that's my lame attempt at a joke there.
Yeah.
So, no, I don't know. I don't know why it's so cheap, Paul. Regulatory issues. I mean, pawnbroking always seems to get a sort of lesser of the two evils type judgment from the regulators, doesn't it? When they do look at this type of thing, because it's non-recourse borrowing, doesn't affect your credit rating. Sometimes people just need emergency cash for whatever reasons, and not just hard up people, quite affluent people who are maybe a bit stretched. There's all sorts of reasons why pawnbrokers are useful, I think. So no, I don't understand it. I should probably buy a few just so that if somebody does bid for it, we can say, "I told you it was cheap."
A guy called Alex Illick, he's asking twice on Eurocell, so I'll just sneak that in the last. It's basically a building products business. I think there's doors and windows and stuff. I think you might have liked it before than what you.
Yeah, I love it. I love it. I thought the update was good. It wasn't good. I think it was slightly below par, the recent update, but it's so cheap. And they've been remarkably resilient. They cut costs and the profits have been, even in a really big downturn in their markets, their profits have remained surprisingly robust. And I think that says to me, this is a really good business. It's got a lovely balance sheet. It's paying generous divvies. I think it's great. I think, of all the things, if the building, supplies sectors, even if it doesn't recover, I think this one's safe as houses. I really do. I think it's very, very good. No position personally, but I think it's very good. Yeah.
I think one of its rivals, Etwin, came out with a reassuring statement just recently as well for doors and windows and recycled sort of.
I can't remember, but Etwin's another one that's a good business, good solid business. These,
yeah. Brilliant. Okay, well, thanks again, Paul, for your insights and comments, and thanks everyone for your questions. And very much look forward in touching base this time next week for another small cap wrap up.
Yeah, we're back to our weekly schedule now. We've had a week off, and let's hope these more buoyant conditions continue.
It hasn't been a buoyant week for my portfolio, but then again, one of those things. Such is life. So thanks anyway, guys. See you next week.
Yeah, thanks everyone. Bye.